I fully expect silver to outperform. It's done that historically. It's a smaller market. It's got more upside. Even the mainstream press is talking about $30 silver, and it's going to be in deficit for years. I think that silver is probably the legacy investment of the next decade or two. I mean, if you're 30, 40, 50 years old and you want to leave a legacy for your family, certainly everyone should own some gold. But if you really want to hit a home run and you're patient, I would suggest, you put away some physical silver and store it either where you're comfortable with it or a storage facility that you can verify is on the up and up.
Silver prices outperformed gold last month with a sharp jump of more than 8%. The spike in silver prices was led by increasing industrial demand for the metal amid optimism over more stimulus measures in China. Meanwhile, the gold-silver ratio has been trending below 80 for months. A fall in the gold-silver ratio indicates a pull-up in risk appetite, a rise in industrial demand for silver, and slowing safe haven demand for gold. David Morgan, CEO of the Morgan Report, predicts silver will likely outperform other assets. He points out that historically, silver has demonstrated the potential for significant growth due to its smaller market size and potential upside. Mainstream media has been discussing the possibility of silver reaching $30, and there are indications that it could remain in deficit for several years. During market downturns, silver has seen its price drop significantly, such as during a crash when it fell below $9. In comparison, gold experienced a 30% decrease in value. However, both metals rebounded swiftly. Silver, in particular, surged from around $9 to approximately $50, marking a more than 500% increase. Gold, on the other hand, doubled in value during that time. Morgan predicts a third upward movement in the silver market, which could be triggered if gold surpasses the 2060 level and maintains that position. While silver and gold are physical assets that reflect the base money supply, Morgan sees silver as scarce and precious due to its limited supply, making it valuable over time. Discussing market dynamics, Morgan emphasizes the behavior of commercials, primarily banks, in the silver market. Unlike primary silver producers aligned with shareholder interests, larger entities often hedge their positions, including silver, due to its relatively minor impact on their overall profits. This behavior influences bullion bankers who engage in market shorting to maintain price levels and respond to supply changes. We will now bring you clips from David Morgan's interview with Commodity Culture. But before we do, if you want more videos like this, hit the subscribe button and turn on the notification bell for more updates. Thank you, and enjoy the video.
Silver is at 21, and during the crash, it went really below 9. And gold went from where it was down about 30%. Both of the metals rallied rather quickly. In silver's case, it went from, I'll call it $9 to roughly 50. So over 500%. And gold, if I remember correctly, was about a double. I'd have to look. So silver definitely outperformed gold. That was a second leg up in the silver market. And that was a 5-fold increase. Usually the third leg up, which we're coming into once gold breaks above the 2060 level and stays there, usually the third leg up is twice as good as the middle leg or the second leg. So if you get a 5-fold increase in the price of silver in the middle leg, theoretically, historically, it'll be 10-fold. So if we go from the bottom, we'll call it the bottom of the illness in March 2020, it's hit, I think, 12. And you multiply that by 10, you're looking at 120. If you looked at that as an anomaly, and silver was more around the $15, $18 range, and you do a factor 10, you're looking at $180 silver. Now, that doesn't mean it's going to do that. All I'm doing is giving you probabilities, high probabilities. I'm not one of these people that think gold's going to 50,000. It's going to cover all the outstanding credit, because silver and gold are actually physical assets that reflect the base money supply, or the kind of money you fold in your pocket, or M1, that type of thing. Others disagree. That's my take. And I'm not budging. I mean, if I was given them different, someone could convince me I've changed my mind, but no one can or has so far. So it's an element that's used as money, and there's only so much of it, which makes it scarce, makes it precious, and makes it valuable. Normally, the commercials, which is basically the banks, it's really not too many companies that are primary silver producers that hedge silver. They know their shareholders are silver nuts and that they wouldn't want them to hedge. But who does hedge are your conglomerates, your RTZs, your BHPs, your multinational multi-billion-dollar mining concerns that mine every element on the planet, and they're huge. Silver is a very small portion of their bottom line, and they do hedge. In fact, they basically don't care about silver in most cases. So there is that. And that information is given to the bullion bankers that basically keep shorting the market because, one, it maintains a certain price level. And secondly, they have the most information. They know how much is being produced at any given time. So they know when the supply will change up or down and act accordingly. So the point is that, yeah, it's very rare for the banks to go long, very rare. And they are. And this is a wake up call. Is it really significant? Remains to be determined. I think it will be significant in the longer run. It might be significant immediately. I'm not going to get all excited. I've been in this market way too long. I've seen things that got me very excited and then turn into nothing burgers. And so this gray haired old man is going to just kind of wait and see. But it is a positive. There's no doubt about that. Is it an extreme positive? I don't know. There's a lot of derivatives on the over-the-counter market that probably dwarfs what we see, and no one ever talks about this. So J.P. Morgan is short, short, short. Well, in the market that we can look at, which Ted analyzes almost obsessively, that's true. I won't argue a fact. However, what we don't know is in the over-the-counter derivative market, they may be net long. They may have wiped out every short position they have on the COMEX with a long position somewhere else. And the other part is the LBMA. It's not as transparent as the COMEX. We really don't know how many times that silver's been hypothecated and rehypothecated, put up for collateral, got a loan against it, swap against someone else. It's leveraged against the gold silver ratio. I mean, there's a lot of games that go on in all markets, and particularly in the precious metals.
In 2020, investment demand for silver surged to record levels. Institutional investors bought 320 million ounces of silver, and retail investors bought 200 million ounces. This total of 520 million ounces accounted for over half the total silver supply of about 1 billion ounces. This sudden and significant demand had a major impact on the silver market. Since then, institutional participation has decreased considerably, and they are not currently driving the ongoing rally or sideways movement in the market. Morgan emphasizes that investment demand is the crucial variable in the silver market. Industrial demand for silver remains relatively constant, but investment demand can cause significant fluctuations. Morgan believes the potential scenario of scarcity is emerging in the silver market. If institutional investors start purchasing silver on a larger scale, there could be competition between industry, which requires silver for various applications, and investors who seek silver as a safe haven asset amid fears of a collapsing monetary system. This competition could lead to a frenzy in the market, given silver's dual role as an industrial and monetary asset. Let's get back to the interview.
So if we go back to 2020, and I think that's when we got that pretty big surge, what happened that year was very few people actually know. And that is, in 2020, investment demand for silver was 320 million ounces from institutions and 200 million ounces from the retail investor, for a total of around 520 million ounces. That's better than half the total silver supply. The total silver supply is about 850 for mining and 150 from recycling, for a round number of 1 billion. So 520 is better than 50% of the total recycled and mined silver in 1 year. It's a phenomenal amount of demand. Since then, the institutions have backed off considerably. In fact, they're really not participating in this rally or this sideways movement that we're seeing currently. And that's the swing factor. It's always investment demand that's going to take it because, again, industrial demand is pretty much a constant. So if silver is a popular investment or is it not? And it's the investment demand. So I like to point out that there's about five, and I got this from Tavi Costa, that did an interview that I participated in, or a presentation, I should say. He told us that there's $5 trillion sitting on the sidelines, maybe more than that now. So 1% of that's 50 billion ounces, 1%. And 1% of that sitting on the sidelines money is equal to 2 complete years of silver production and recycling. So if you don't think in a next financial panic that at least 1% will find its way in the silver market, then go ahead, challenge me. I may be right, I may be wrong, but I think you'll see at least 1%, if not something closer to 5, maybe even 10 in a real panic. And there's just not there's that much paper money, but there's not that much silver. And so I really do expect what I've said for so many years, and that is the third leg up, the manic panic phase, which we have actually started in gold, but it hasn't been to the manic part yet. It's just basically uh, gathering steam. The run to gold to start with a small walk, and the banks are taking up. Smart money's moving into gold. That's obvious. Silver, they're waiting. Maybe they're networking. Hey, don't promote silver and don't buy it. Because again, this would be a time. But coming full circle, we have an indicator now that the banks are net long. So wait a minute. Well, the banks have gone net long gold, much greater quantities than in a long, long time, the last few years, couple of years. And now maybe they're moving into silver, at least temporarily. So I am quite bullish, but the demand side that pushed the silver price up in 2020 was investment demand. And again, that's what will take place. I think there could be a time where it's difficult to source silver at the retail level. We've already seen that previously, maybe even at the wholesale level, especially if the institutions come in, because the institution buys 1,000-ounce bars like investors buy 10-ounce bars or 100-ounce bars. So if that were the case, you would see competition between industry needing silver to stay in business and investors needing silver because the money system is collapsing or they fear that it's collapsing. So that would feed on each other. So you'd have kind of a shark feeding frenzy going on because silver has those attributes of being both industrial and monetary.
Silver prices are projected to increase by 6% in 2023 amid continued high demand, before falling 4% next year. Silver has proven its resilience during times of economic turmoil and financial crises. What are your thoughts on the future potential of silver in the market? Please share your thoughts in the comments section below. If you found this video informative, remember to give it a thumbs up, subscribe to our channel, and enable notifications to stay informed about our latest videos on silver, gold, and copper. Thank you for watching, and we appreciate your support.